Hello and welcome to Midsummer. I'm Helios, Greek god of the sun. Actually, I'm just Andy Rainford, Chartered Tax Advisor and Content Editor. I'm here with your latest tax update from the Tax Essentials for Advisors platform. As always, we'll split the update into three sections. This week's highlights include a new legal framework for crypto investors, two important webinar dates for your diary on MTD, and an interesting EIS case that has nothing to do with the EIS legislation. Right, let's kick off with our general roundup. The new crypto asset reporting framework will take effect in the new year. If you have clients that buy and sell crypto assets, you need to bring this to their attention. From the 1st of January, they will need to provide personal details, including their NI number and tax reference number, to every service provider they use. Failure to do so will risk a £300 fine from HMRC. It's a timely reminder that gains and income from crypto assets are taxable and should be reported on the tax return in the same way as other assets. The rules around what constitutes income or gains can be complex. For example, using Bitcoin or other cryptocurrency to pay for goods or services can trigger an exchange rate gain. If you need more information, review HMRC's Crypto Assets Manual for guidance. Next up, an urgent payment deadline. It's literally the 11th hour, so there is no time to waste with this one. Your employer clients need to pay any Class 1A national insurance very shortly if they haven't already done so. If they pay electronically, the deadline is the 22nd of July. Yep, that's next Tuesday. If they usually pay by check, the deadline is 3 days earlier, so if they haven't sent it yet, advise them to pay electronically wherever possible to avoid non-compliance. A quick update on the marriage allowance, or at least the guidance about backdating claims. HMRC has added info about how to claim for previous tax years to its online guidance. It's worth remembering that a claim can be backdated for the 4 previous tax years where the conditions are met, so it's a reminder to look into this for your clients when making a claim. It could be worth over £1,000. We're less than 9 months away from the first mandation of MTD for income tax, and HMRC is ramping up its publications in readiness for it. I've got 2 webinars to give you the lowdown on. The first will be a general one on how to prepare for MTD as an agent, and that is on the 21st of July. The second is around client authorization and enrollment, and will be on the 24th of July. I've provided 2 custom links here for you. If you can't make the dates, register anyway, as you will be sent a link to watch a recording of the webinar in your own time. Okay, cases then. And I was initially excited to see a case about EIS shares. If you know me, you'll know I literally wrote the book, or at least a book, on the venture capital schemes. However, the case is actually about HMRC trying to shove a square peg into a round hole and apply the transactions and securities rules. The EIS shares were a red herring. These rules are there to prevent transactions that are really income being taxed as a capital gain, but the details here were a little convoluted. The 2 taxpayers owned shares that qualified for EIS income tax relief, meaning that they would be exempt from CGT when eventually sold. However, they were concerned that a change in government in 2015 might lead to scrapping this exemption. They entered into a share buyback to preempt this and secure the relief. HMRC tried to argue that one of the main purposes of the buyback was to secure an income tax advantage on the basis that the CGT relief depends on there being an income tax reduction. Given that the income tax reduction was secured by making the initial investment several years earlier, and the date for any clawback of this having passed, it seems ludicrous that HMRC tried to reason that selling the shares was motivated by an income tax reduction. It's true that there has to have been an income tax reduction for the CGT exemption to apply, but this just seems like, as Pumbaa from The Lion King would say, HMRC trying to put its behind in the past. Amazingly, the first-tier tribunal agreed. Thankfully, the upper tribunal said that the income tax advantage was the effect rather than the motive for the transaction. By the way, the supposed income tax advantage was due to the taxpayers choosing a share buyback instead of receiving the money as a taxable distribution. I find this completely irrational and fully agree with the taxpayers' assertion that, were HMRC's argument correct, it would be a major barrier to investors being motivated to provide finance via government-approved schemes. Is putting savings into an ISA motivated by an income tax advantage? Of course it is. That's literally the point. Not only was the appeal allowed, but the judges said that the lower tribunal had erred in law. So last up, is a rat-infested property suitable for use as a dwelling? Well, yes, according to the Court of Appeal. Here, two individuals purchased a property in London with a view of making it their main residence. Unfortunately, the property had been vandalised, had fixtures removed, and had severe vermin problems. The renovations took 9 months. The appellants argued that the stamp duty land tax should be based on non-residential rates, as the property was clearly uninhabitable, that is to say, not suitable for use as a dwelling. The court disagreed and said that a dilapidated dwelling was still a dwelling, and to preclude properties purchased in a state of disrepair would be nonsensical. That brings us to the end of this update. Last time I did promise I'd let you have joining instructions for our next live webinar, and I'm pleased to do so here. The topic is the new rules for non-UK domiciles, and I'll be welcoming Rachel Brown, Chartered Tax Advisor and Private Client Manager at Claritas, to go through the foreign income and gains regime and how to advise former remittance basis users. Hope to see you all there. Until next time, it's goodbye from me, Andy Rainford, and the team at Tax Essentials for Advisors.